I want to talk about commercial papers. How do commercial papers work? I want to talk about the essential features, the characteristics of commercial papers. That's something every smart investor should be able to understand or ought to understand. And so here are the key features of commercial papers. Number one is short-term debt instrument. It's a short-term debt instrument. Commercial papers are short-term unsecured debt instrument issued by corporations, typically with maturities ranging from overnight to 270 days, usually between 30 to 90 days. They're essentially short-term debt instruments. They don't really have, a long maturity period like bonds that may take a year, two, 5, 10, as much as even as much as 30, 40 years. They are usually they are used to meet short-term funding needs of the company, like working capital requirements, like financing inventory and other short-term funds for boosting the operation of the issuing company. We should not forget the fact that it is short-term, very short, just between a month and 3 months. That's 30 to 90 days, and is usually adopted to raise funds, issued to raise funds to sponsor or to fund a company's operation in the short run. Number two is unsecured. When it comes to this particular concept, the commercial paper here is not secured by the assets of the company. The company needs not to mortgage any of its assets to be able to issue commercial papers compared to secured bonds. And so commercial papers, are not backed by collateral, making them a form of unsecured debt. This means that the issuing company's creditworthiness is a crucial factor in determining the company's risk. How creditworthy is the company issuing these papers? Are they strong financially? How is their balance sheet? How are they doing, generally when it comes to their finances? And these factors will determine the creditworthiness, of the issuing company, how risky the commercial paper is. Number three is issued at a discount. These papers are issued at a discount. Commercial papers are often issued at a discount to their face value, meaning investors buy them for less than their face value. That is how it operates, and are paid, full value at maturity, with the difference, representing the interest earned. A typical example, if a commercial paper, let me use my country's currency. If a commercial paper is, let's say, 100,000 naira, all right, they may decide to issue it at probably, 80,000 naira. So you buy at 80,000 naira, then at maturity, the company pays you 100,000 naira. So 100 minus 80 is 20. So 20,000 naira is the interest, gain, the interest earned. So they are issued at discount, and then you get your money back at full value. That difference represents your returns. Number five is number four rather is the issuer. Typically they are issued by generally large, financially stable corporations. Commercial papers are mainly used by companies with strong credit ratings. They are less commonly issued by smaller or riskier companies. These are issued by strong, reputable blue chip companies, and so it makes it more attractive, to investors. And in this case, they always have that particular strong credit rating, which guarantees the fact that yes, the investment, is somewhat relatively safe, so to say. Number 5 is low minimum investments. Low minimum investments. The minimum investment in commercial paper is typically, if you use the US currency, is often around $100,000 or more, making them more suitable for institutional investors, money market funds, and high net worth individuals. So rich people could invest, companies, could invest, fund managers could equally invest in these instruments. Number 6 is low yield. This is a very important consideration. It's really kind of low. The yield obtainable is low compared to vehicles like the stock markets. All right. And so, due to their short-term nature and low risk from reputable issuers, all right, so the risk is somewhat minimal, but the yield is relatively low. So commercial paper generally offer lower yields compared to other debt instruments like corporate bonds or certificate of deposits, lower than what you could even obtain in the stock markets, in the typical bull market. So take that into consideration. Security, stability, predictability of your returns, but invariably the yield is somewhat low. Please subscribe to this channel and like this video. And number 7 is no fixed interest payment. Unlike traditional bonds, commercial paper do not offer periodic interest payments. Instead, investors can earn the interest through discount at which the paper is issued. There is no regular interest payment like bonds. No payment like bonds, but rather if you buy at, let's say, you buy at 80,000, and then at the end of the maturity period, the company gives you 100,000. So plus or minus, you have you have 200, you have 20,000. That signifies your returns. That is what you stand to gain actually, and it's relatively low compared to other investments. So you take that into consideration. Number 8 is highly liquid. Highly liquid. Commercial papers are considered highly liquid because they are, they have that short-term duration. And in the case, where the issuer is highly rated when it comes to credit worthiness, you discover that that liquidity is enhanced. It could be very easily sold in the open market because of the trustworthiness, because of the strength, the reputation of the company issuing these instruments. Number 9 is ratings. Commercial papers are usually rated by credit agencies such as Moody's and Standard & Poor's. Based on the reputation, based on the financial health of the issuing companies. All right, that indicates the lower risk of default. The stronger the company, the higher the rating, and the lower the risk of default. Number 10 is use of proceeds. Commercial papers, typically are issued so that the company can use the proceeds to fund their short-term, operational needs, such as manage their day-to-day operations, covering payrolls and paying their suppliers. So these the income obtained or the fund raised in this particular instrument through these instruments, is used to cover short-term, day-to-day financial needs of the issuer of the company. Number 11 is repayment at maturity. Commercial papers are repaid at their full face value upon maturity, and that the issuer may roll over the debts by issuing new commercial papers to pay at maturity. They have that particular leeway of rolling over the debt. Instead of paying the principal at maturity, they can reissue another tranche of commercial paper instead. These features make commercial papers a convenient, low-risk investment option for institutional investors looking to park, cash temporarily for, a short time. They are not really suitable for retail investors due to their high minimum investment requirements and short-term nature. It's for people who can really afford it, for institutions, for big fund managers, for high net worth individuals. It's not for small investors like I and you who are looking for short-term, who are looking for. It's for people who are really in the big league. But don't be discouraged, okay? With time, we'll get to that big league eventually.